This is what I really wish I would have known sooner when I graduated so that I could have bought my first home sooner. Like most new grads, I immediately jumped into renting an apartment with a roommate. We furnished it and decked it out nicely, and it was a cool bachelor pad. But I didn't buy because I assumed that you had to have a 2-year work history and that you also needed this ginormous down payment, both of which I didn't have. But here's the secret that I learned, unfortunately, many years later when it was a little late. It's that most lenders will actually use your college transcripts and your diploma or degree as proof of work history. So you could take your new starting salary at your brand new job and couple that with the really low and creative down payment options that are out there in the marketplace to be able to get into a home right then and there straight out of college. Now, had I done this, especially back in 2002, this would have got me on the property ladder much sooner, saved me a lot of money that ended up getting wasted on rent in those early years, probably improved my dating prospects in life a little bit because, of course, everyone wants to date a guy who's got his stuff together, and owning a house is one major way of stating that. But I would have started building wealth and equity right away, and that was a real serious run-up in housing, ultimately before the major crash of '08 that I missed out on. So if you're a recent college grad, I want you to keep watching this because I'm going to show you 3 ways that you can exactly leverage creative financing to buy your first home much sooner than you would have originally thought. And if you stay until the end, I'll actually give you a checklist to make this all work out. My name is Arjun Dhingra. I am a 23-year veteran or student, depending on how you want to look at it, of the mortgage industry. I'm a 2-time Taekwondo world champion, former Team USA co-head coach, father to 2 beautiful girls, and I live in Marin County here in Northern California. Most of the recent years of my career have been dedicated to creating content that is informational and useful to would-be buyers and helping people understand the prospects of taking out mortgage debt and making it to their advantage. And if you would like to help me in reaching more people so that I can help and guide them as well, please like and subscribe to this video on my channel. All right, first things first, how do lenders actually look at college grads? So most importantly, lenders want to know that you can actually afford a monthly housing expense. And for new graduates, this is going to come from your job offer letter and your actual school transcripts. That's the key. Your transcripts actually count in lieu of that 2-year work history that you thought was going to prevent you from buying right now, but actually allow you to do so immediately after graduation. So your starting salary can actually be a really powerful tool because there are down payment options as low as 3%, and in certain rural areas, you can put down 0. So years ago, I had a fraternity brother who reached out to me, and he was older, but his son was getting set to graduate college. And he told me that he was thinking of offering him 2 options of a graduation gift. One would be money to basically travel and backpack all through Europe. So standard and cliche, I know. Or the other option was going to be a small enough down payment for him to buy his first home right there that summer. Now, the second option doesn't sound nearly as sexy as traveling through Europe and all the great stories that you'd have with you for the rest of your life. But this young man was smart enough to actually realize that the second option, although a little bit more boring up front, was gonna be much better for him, and in the long run, enable him to take as many backpacking trips through Europe as he'd love to take. So he used his starting salary to qualify for an FHA loan with 3% down, and he bought a multi-unit property where he lived in one unit and rented out the others. And in his particular situation, the rent that came from the other units pretty much covered 90% of his overall mortgage expense. So he was living almost for free in a property that he had tax benefits from right away and was going to rise in value at a very sharp clip because it was multi-unit. And after just 1 year, his equity grew from the 3% down payment that he had to a little over 10%. Since that time, he has moved on from that home and fully rented it out and repeated this cycle with multiple homes. He's now in his late 20s, owns 5 properties, and financially sits better than people double his age. Clearly, he made the right choice with that graduation gift, and I couldn't be happier for him. But this video is about you and how it's your turn to do the same. So now, going back to income, that's only one piece of the puzzle. You also need the down payment. Here are a few creative options on how to arrive at it. So just like in that previous example, gift. So gifts are the most common way that young borrowers get their first down payment. Just like in my previous example where that father gifted his son 3% for his down payment, this is the most common way that people actually get into homes for their first time. So although asking a family member for help isn't always the easiest thing to do, when it comes to your down payment, it just might be the most accessible. The second down payment option for creativity are grants. There are over 200 towns or housing markets that offer grants for down payment assistance. It's literally free money. You just have to apply for it and can find these resources online. Third, and least known, is what's called shared equity. There are programs like Home Partners and Unison, which offer buyers the ability to put down a small down payment from their end, and then these companies will come in and shore up the rest of it. You just have to share in the equity and profit taking at the time of sale. Now let's go back to gift money, because this used to be a lot more complicated than it actually is now. Formerly, you would need to get bank statements from that family member to show that they actually have the money, and there would be a process for how they needed to wire it to you, and then have you ultimately wire it in to the title company during the time of a purchase. But that has all changed in recent years. So long as you have the commitment from that family member and it's been approved by your lender that those gift funds will be allowable in the transaction, there's literally only one transfer that needs to actually occur, which is directly from the family member to the escrow company, and it bypasses you and leaves you out of it. Now, depending on family situations, there may or may not be a taxable event. That's something you would need to consult your CPA for, or that can remain the business between simply two family members. And ultimately, a gift letter will be needed for the loan underwriter, but this is perhaps one of the easiest down payment option avenues to pursue. Now, going over to down payment grants. You apply for these by finding these resources online. The application process is generally pretty straightforward and simple, and the money is then provided to you. Now, unlike loans, there's no repayment of a grant, but you do have to qualify for it, and there can be some fine print attached. So you want to check closely with your state housing agencies and see what types of grants are actually available for you as an eligible buyer. And when I say eligible, you have to meet certain income requirements or thresholds. And grants are only as good for as long as the money is actually there. So when a new grant hits the market, it's generally so popular that the money dries up quickly in a matter of months. So make sure you check those important websites to not only know about the requirements of these grants, but the true availability of those funds. Now, with shared equity programs, personally, I'm not a huge fan of these, but I know that they are a possibility and many buyers out there take advantage of them. Again, my personal thoughts and feelings are that I don't want to necessarily be tied to a business partner in a transaction that's mine. So I would much rather either go and apply for a grant where I know the money comes to me with no strings attached to it, so long as I qualify, or get it from a family member where everything is laid out and clearly understood in terms of how I'm getting that money and whether or not I have to give it back to that family member over time. So again, just to summarize, your three options for accessing a down payment are gift funds from a family member, state and local programs that offer you a grant, or shared equity programs that cover most of the down payment. Now, any one of these three options will allow you to access a home much faster than having to save up over time and build up a 20% down payment. These can allow you to buy a home literally after graduating college right away. Owning property is perhaps the greatest wealth hack there is in the United States, and there's no greater country for being able to do it. Just think about it. There's an asset you want, and a bank is literally willing to give you 97% of the money of that asset in order for you to take ownership of it. In no other country does that happen. So the sooner you start, the faster you start to build appreciation and equity in something that's yours, not to mention take advantage of tax breaks and incentives on day one. And if you really want to build up equity and start hacking your way to wealth, make sure you hit like and subscribe to this video so that I can continue to share more videos with you about mortgages, motivation, and mindset. So at the end of the day, don't just focus on monthly housing expenses of thinking that because renting an apartment is going to be cheaper, that that's somehow better for you. Sit down, talk to an actual real advisor or your parents if they've done this successfully themselves, and look at all the real numbers and the benefits, because that higher housing expense by way of ownership is going to be so much better for you, not only in the short run, but the long run, as opposed to renting. So here's that checklist for you to make this all possible, as promised at the beginning of this video, if you are a new college graduate. First is find an actual mortgage advisor. Mortgages are like credit cards. You can go online and just apply for one, but that doesn't mean you're going to get it paired with the right mortgage strategy. A mortgage advisor is someone that probably has bought and sold many homes themselves, but have advised clients on not only the mortgage process itself, but tax and overall wealth building throughout the process. Next, consider strategic down payment loan programs like the FHA loan, where 3% is only required, or even a USDA loan where you can finance 100% of the purchase price, depending on the location. Look at homes that are just below your max qualifying budget, because ultimately you never want to be house poor. Target homes or properties that have the opportunity to be able to rent out bedrooms or units if you buy a 2 to 4 unit property. And just remember that owning 10 out of 10 times beats renting, even if it's more expensive up front on paper. You build equity and wealth and get tax benefits that you will never get to realize if you're cutting a check to a landlord and paying their mortgage instead of your own. So don't make the mistake that I made back in 2002 when I graduated college. If you're serious about building wealth for yourself, then learn from this video and see how you can get into a property much sooner than I ever did. Leverage those low down payment programs and get super creative with your financing, because it's all possible. You'll ultimately become a homeowner much sooner than you ever would have thought. Let me know in the comments section what you learned from this video or found useful, and if there's anything further that I can bring you in the way of value or education on this topic. Stay tuned for more videos like this on homebuyer education for people that are fresh out of school or have just landed their first job. I'll see you on the next video.